Today I'll be showing you guys an easy option strategy that you can do on a stock that you think is going to move either up or down. So for this example, I'll be showing you guys on Delta Airlines. And if you enjoy option strategies, be sure to subscribe to my channel for more videos just like this one. So like I said, we're going to come over here to Delta Airlines because we're looking for a stock that is pretty volatile and moves a decent amount. If we look at Delta Airlines here, just because of everything happening, Delta has been moving by a couple dollars weekly and even daily. Let's go to the past 3 months. So yeah, we can see that Delta's been pretty volatile. We'll go back to the week. So yeah, it's about 30 here, drops to 28.90, back up to 31 up here. So it moves a decent amount. So we're going to come over here to trade Delta Airlines options. And this option strategy is called a straddle, and it only consists of two pieces to it. We're going to buy a call and we're going to buy a put. So first things first is we're going to set our expiration dates. We're going to want to set it at least a week away, preferably 2, just to give Delta some time to move away from the middle. So for this example, I'll show you guys on July 8th. I'm recording this on the 28th of June. So that gives us about 10 days, a little bit around there, to move around a little bit. So first things first, we're going to buy a call where we want Delta to not be at. So for this example, I'll show you guys just right here, right at the share price. So as long as Delta goes up or down, we'll be good. So first piece is we're going to buy the call right there, and then we're going to buy a put at the same spot. So we're going to buy it right there. So it'll look like this, and if you have long straddle up here, then you did it properly. And so you should see something like this. So the max loss is $210. That's if Delta is at $3.50 on July 8th. But like we said, we're doing this on a volatile stock, so we're going to hope that Delta goes up or down. You can prepare for stock option strategies like this on stocks that are approaching earnings because they're pretty volatile, but do be aware of the IV crash, the implied volatility crash. So look into that if you're curious what that means and how you can prevent that from happening. But with earnings, stocks are pretty volatile, so that is a chance to use this strategy, or with any other news that just comes out about a stock, or any worldwide news regarding the entire world or certain countries. If you think a stock is going to be affected by certain pieces of news, you can do this strategy if you think the stock is going to go up or down. And really all we have to do is just make sure that Delta doesn't trade sideways. As long as it goes up, we're good. Our profit's unlimited. As long as it goes down, we're good. You can see right here, for example, if you look on the right side of the screen, it says 26.36. So if Delta's at 26.36 on July 8th, we're going to make about $200 here. And so a way that we can also increase our profits is if we click continue, and you see these contracts right here. These contracts, essentially, to put it shortly, these contracts multiply your profits and your losses. So this $210 right here for one contract, if we switch it to 2 contracts, this will double. So there you go. Now you see it's 420. But with that, the profits also double. So if we get down here by 26 again, now we're going to make $413. So you can kind of play around with that if you like. The first couple strategies, I would recommend just do one contract to get a hang of it and see that you kind of learn the gist of it before you start playing around with too much money. Let's come over here to option strat so that we can better visualize this, because obviously we can't see much on Robinhood. We just see this little graph they give us right here. But if we come over to option strat, we can click on build right here, and then we're going to come down here to where it says directional, and we're going to click on straddle. And so all we're going to do is copy everything we created over here. We're going to put it in option strat to view it a little bit better. So the first piece is we're going to enter our ticker symbol, which is DAL, Delta Airlines. And then we're going to make sure that we chose the correct expiration date, July 8th on Robinhood. Yep, it's already set to July 8th. Then all we do is just copy these 2 pieces right here with these sliders right here. And it's already there actually, 30.50 for both. And so there we go. So you can see, obviously you see it a lot better than on Robinhood, which is why I like to go to option strat. You can play around with the chart range. So if you watch this left side, you can see the dollar amount skew when I move this slider. And so we can kind of visualize that a little bit better. You can see, and then obviously, like I mentioned earlier, the implied volatility regarding earnings and reports of that nature. So you can play around with implied volatility and see how that affects it. For right now, we'll just reset it. But yeah, like I said, you can see things a lot better. If you come over here, you can see if delta is at $32.30 on the 30th of Thursday at 7:30 a.m., we'll make $30. That says it right there. If delta's at $34.10 at 2 p.m. on Monday the 4th, we'll make $152. And so you can use this to kind of see a lot better than what Robinhood shows you, which is virtually nothing. And so that's why I like to come over here to Option Strat to visualize things a little bit better. But if you have any questions, be sure to comment those down below, and I'll be sure to answer them all. And like I said, if you enjoy option strategies, be sure to subscribe for more videos like this one. And yeah, thank you for watching.